$174,000. 3 business owners, 3 big savings. Year-end is approaching. Time to save money on taxes is running out. Hey, I'm Ed Lloyd with Ed Lloyd Associates. In the last 60 days, we've seen 3 business clients using 7 specific moves from the One Big Beautiful Bill Act. But here's the problem. 5 of these strategies either expire or fundamentally change at the end of this year. The year-end's coming quickly, time is running out. If you're a service-based business owner making $2 million or more in revenue, the next 11 minutes could be worth $100,000 or more to you. Before we dig in, hit subscribe. We drop advanced tax strategies every single week. All right, let's get into this. Number 1, 100% bonus depreciation is back in play for 100% of assets placed in service after January 19th, 2025. I've got a medical practice owner who had $186,000 of medical equipment he was looking at buying in February of 26. We looked at his tax strategy for this year, and it made sense to pull it back into December. The result? The $180,000 is a tax deduction in 2025. That was a $63,000 in federal tax savings for the client. Here's an important piece that people miss. The asset has to be placed in service to be able to be depreciated. So what does place in service mean? It means that you have the asset and then it's operational. If it's equipment, you've got to have it on site and be using it. If it's real estate, it has to be rentable. Whatever the asset is, it has to be operational to be able to take the deduction. So if you have assets you need for your business, make sure you've acquired them and have them in operation before the end of the year if you need the deduction this year. Step 2. Section 179 depreciation has increased from $1.2 to $2.7 million in 2025. This is a huge win for larger equipment purchases. One of our consulting clients needed 3 vehicles for their business this year. The total cost was $210,000. We used Section 179 combined with bonus depreciation. We're able to write the whole thing off this year, saving them $73,500 in income taxes. That's especially valuable for heavy trucks and SUVs weighing 6,000 pounds or more. Utilizing Section 179, you're able to write off the entire purchase if it meets these requirements. The strategy here is layering. You utilize Section 179 and 168 together to help maximize your deductions. Review your next year capital acquisition. Look at what you need to buy next year. Does it make sense to bring it into this year and maximize your deductions? The rules have changed, so the opportunities are available to you. Quick question for you. Which of the first 2 moves are going to work best for you? Equipment or vehicles? Drop a comment below and let me know. Move number 3. The 20% qualified business income deduction is now permanent. This is a great deduction for pass-through business owners. So how does this work? If your entity structure is an S-Corp or a partnership and you've got $500,000 of income, that's $20,000 or $30,000 of taxes that you're saving every year. Let's look at this. To save money and get this QBI deduction, what do you have to do? All you got to do is make money. They're giving this to you tax-free. All you have to do is follow the rules. Now, if you're a specified service business, there are some restrictions on income. There are 13 areas that the IRS looks at for specified service trader business: health, law, accounting services, actuarial services, performing arts, consulting, athletics, financial services, brokerage services, investments and investment management, trading, dealing in securities, or when the principal trade or business is reliant upon one or more individuals in the company. Now, there are a lot of nuances within these broad categories. Some people that are in them still qualify, some of them don't. The important thing is to understand which ones work for you and make sure you maximize this. One of the things we work with our clients is what we call the QBI rescue. If you're in one of these fields and you're making too much money, we use tax planning to pull your taxes down, which then increases and gets you some of this free 20% money that you got. Another consideration is if you're the wrong entity type. We had a Schedule C client that was making $380,000. Because of the amount of income and what they did, they were not able to take the QBI deduction. So what did? We converted them to an S-Corp. Did 2 things for them. 1, cut the Social Security taxes. 2, increase their QBI deduction. Just this one move saved them $18,000 on the QBI plus Social Security taxes. This is a savings for this year and every year going forward. Move 4, immediate R&D expenses. This is a big deal for clients that have had to amortize these costs over 5 years. With the change in the bill, you can expense these immediately. This allows us to go back and recapture those deductions you couldn't take before. We can get your money back for 22, 23, and 24 and start expensing them with the new law in 2025. that can be a huge tax savings for you. Here's something most business owners don't realize. Software development, process improvements, new service line developments. These all qualify for expensing and credits. There's lots of benefits in the R&D section. Make sure you're taking advantage of them. All right, if you're still watching, you're serious about this. You're wanting to cut your tax bill and you're trying to find out ways to do it. Go ahead and schedule a time now on the link below so we can get started and help you save money on your taxes for 25 and going forward. Okay, move 5. Business interest deduction limitations have been improved. Before, they are based upon earnings before interest and taxes. Now it's based upon income before interest, taxes, amortization, and depreciation. So what does that mean? That means you've got a bigger possibility for a deduction, for more interest expense deduction in 2025 if you had been limited in the past. Move 6, SALT tax bunching. Here's another one of our free tax deductions. We want to make sure we maximize free tax deductions because they don't cost us any cash. SALT limitations were raised from $10,000 to $40,000 with limitations based upon your income. So how do you work within all of this and still maximize your tax deductions? The same as we've been doing for our clients for years. If your state allows you to pay tax at the entity level, you want to make sure that you're taking advantage of that. So how does this work for you? Let's say you've got $50,000 in taxes that are going to flow down to you that you're going to owe the state for income your business made this year. Those tax deductions are going to be wasted if you're not taking advantage of it at the state entity level. If your state allows, you want to pay that tax at the entity level. That means you get 100% deduction for it with your business tax return. Then whatever is left over, you run through your Schedule A and look at the limitations that are available to you. If you couple those two, you maximize the increase and you maximize the amount that you're able to take in your business. One of our clients we've been working with has over $1 million in tax deductions just by utilizing this one strategy. That's real dollars and the cost to you is nothing. All you're doing is changing which pocketbook you're writing a check from. Move 7. Charitable contributions. They've placed a 0.5% limitation on what you're able to deduct. That means the first 0.5% of your AGI may be limited to charitable deductions in 26. So what do? If you have a gifting strategy in place, you can take the gift that you were looking at making over the next couple of years, bring it back in 2025. If you put it in a donor advised fund, this allows you to give in the same schedule that you would have, but just maximize that deduction. It's important to remember with all the strategies I've talked about, what you do or don't do, it depends on your current situation for the current year on how much of these deductions are going to give you the best benefit. That's part of tax planning. So at this point, you've got 2 options. 1, you can do nothing. You can sit back and just wait till the next year, let some of these evaporate, and then you may be paying over $100,000 of extra income taxes. That's a shame. Option 2, get a plan. Schedule below. We'll look at your situation and see how we can maximize your tax savings for this year and going into the future. We do planning throughout the year. We're constantly saving 6 and 7 figures for our clients. Find a time that works for you today so that you can save some money. Make sure you like this video, subscribe, and if you got somebody who will benefit, please forward it to them. Until next time, I'm Lloyd. Stop just making money. Let's keep more of it.